Proponent, monetary imperialism, and the gold exchange standard. The leap into political imperialism by the United States in the late 1890s was accompanied by economic imperialism, and one key to economic imperialism was monetary imperialism. In brief, the developed Western countries by this time were on the gold standard, while most of the Third World nations were on the silver standard. For the past several decades, the value of silver in relation to gold had been steadily falling due to 1, an increasing world supply of silver relative to gold, and 2, the subsequent shift of many Western nations from silver or bimetallism to gold, thereby lowering the world's demand for silver as a monetary metal. The fall of silver value meant monetary depreciation and inflation in the Third World, and it would have been a reasonable policy to shift from a silver coin to a gold coin standard. But the new imperialists among U.S. bankers, economists, and politicians were far less interested in the welfare of Third World countries than in foisting a monetary imperialism upon them. For not only would the economies of the imperial center and the client states then be tied together, but they would be tied in such a way that these economies could pyramid their own monetary and bank credit inflation on top of inflation in the United States. Hence, what the new imperialists set out to do was to pressure or coerce Third World countries to adopt not a genuine gold coin standard, but a newly conceived, quote, gold exchange or dollar standard. Instead of silver currency fluctuating freely in terms of gold, the silver-gold rate would then be fixed by arbitrary government price fixing. The silver countries would be silver in name only. A country's monetary reserve would be held, not in silver, but in dollars allegedly redeemable in gold, and these reserves would be held not in the country itself, but as dollars piled up in New York City. In that way, if U.S. banks inflated their credits, there would be no danger of losing gold abroad, as would happen under a genuine gold standard. For under a true gold standard, no one and no country would be interested in piling up claims to dollars overseas. Instead, they would demand payment of dollar claims in gold, so that even though these American bankers and economists were all too aware, after many decades of experience, of the fallacies and evils of bimetallism, they were willing to impose a form of bimetallism upon client states in order to tie them into U.S. economic imperialism, and to pressure them into inflating their own money supplies on top of dollar reserves supposedly, but not de facto, redeemable in gold. The United States first confronted the problem of silver currencies in a Third World country when it seized control of Puerto Rico from Spain in 1898. And occupied it as a permanent colony. Fortunately for the imperialists, Puerto Rico was already ripe for currency manipulation. Only 3 years earlier, in 1895, Spain had destroyed the full-bodied Mexican silver currency that its colony had previously enjoyed, and replaced it with a heavily debased silver, quote, dollar, worth only 41 cents in U.S. currency. The Spanish government had pocketed the large seigniorage profits from that debasement. The United States was therefore easily able to substitute its own debased silver dollar, worth only 45.6 cents in gold. Thus, the United States silver currency replaced an even more debased one, and also the Puerto Ricans had no tradition of loyalty to a currency only recently imposed by the Spaniards. There was, therefore, little or no opposition in Puerto Rico to the U.S. monetary takeover. The major controversial question was what exchange rate the American authorities would fix between the two debased coins, the old Puerto Rican silver peso and the U.S. silver dollar. This was the rate at which the U.S. authorities would compel the Puerto Ricans to exchange their existing coinage for the new American coins. The treasurer in charge of the currency reform for the U.S. government was the prominent Johns Hopkins economist Jacob H. Hollander, who had been special commissioner to revise Puerto Rican tax laws and who was one of the new breed of academic economists repudiating laissez-faire for comprehensive statism. The heavy debtors in Puerto Rico, mainly the large sugar planters, naturally wanted to pay their peso obligations at as cheap a rate as possible. They lobbied for a peso worth 50 cents American. In contrast, the Puerto Rican banker creditors wanted the rate fixed at 75 cents. Since the exchange rate was arbitrary anyway, Hollander and the other American officials decided in the time-honored way of governments, more or less splitting the difference and fixing a peso equal to 60 cents. The Philippines, the other Spanish colony grabbed by the United States, posed a far more difficult problem. As in most of the Far East, the Philippines was happily using a perfectly sound silver currency, the Mexican silver dollar. But the United States was anxious for a rapid reform, because its large, armed forces establishment suppressing Filipino nationalism required heavy expenses in U.S. dollars, which it of course declared to be legal tender for payments. Since the Mexican silver coin was also legal tender and was cheaper than the U.S. gold dollar, the U.S. military occupation found its revenues being paid in unwanted and cheaper Mexican coins. Delicacy was required, and in 1901, for the task of currency takeover, the Bureau of Insular Affairs, or BIA, of the War Department, the agency running the U.S. occupation of the Philippines, hired Charles A. Conant. Secretary of War Elihu Root was a redoubtable Wall Street lawyer in the Morgan ambit, who sometimes served as J.P. Morgan's personal attorney. Root took a personal hand in sending Conant to the Philippines. Conant, fresh from the Indianapolis Monetary Commission and before going to New York as a leading investment banker, was, as might be expected, an ardent gold exchange standard imperialist, as well as the leading theoretician of economic imperialism. Realizing that the Filipino people loved their silver coins, Conant devised a way to impose a gold U.S. dollar currency upon the country. Under his cunning plan, the Filipinos would continue to have a silver currency, but replacing the full-bodied Mexican silver coin would be an American silver coin, tied to gold at a debased value far less than the market exchange value of silver in terms of gold. In this imposed, debased bimetallism, since the silver coin was deliberately overvalued in relation to gold by the U.S. government, Gresham's law inexorably went into effect. The overvalued silver would keep circulating in the Philippines, and undervalued gold would be kept sharply out of circulation. The seigniorage profit that the Treasury would reap from the debasement would be happily deposited at a New York bank, which would then function as a, quote, reserve for the U.S. silver currency in the Philippines. Thus, the New York funds would be used for payment outside the Philippines instead of as coin or specie. Moreover, the U.S. government could issue paper dollars based on its new reserve fund. It should be noted that Conant originated the gold exchange scheme as a way of exploiting and controlling third world economies based on silver. At the same time, Great Britain was introducing similar schemes in its colonial areas in Egypt, in Straits settlements in Asia, and particularly in India. Congress, however, pressured by the silver lobby, balked at the BIA's plan. And so the BIA again turned to the seasoned public relations and lobbying skills of Charles A. Conant. Conant swung into action. Meeting with editors of the top financial journals, he secured their promises to write editorials pushing for the Conant plan, many of which he obligingly wrote himself. He was already backed by the American banks of Manila. Recalcitrant U.S. bankers were warned by Conant that they could no longer expect large government deposits from the War Department if they continued to oppose the plan. Furthermore, Conant won the support of the major enemies of his plan, the American silver companies and pro-silver bankers, promising them that if the Philippine currency reform went through, the federal government would buy silver for the new U.S. coinage in the Philippines from these same companies. Finally, the tireless lobbying and the mixture of bribery and threats by Conant paid off. Congress passed the Philippine Currency Bill in March 1903. In the Philippines, however, the United States could not simply duplicate the Puerto Rican example and coerce the conversion of the old for the new silver coinage. The Mexican silver coin was a dominant coin not only in the Far East but throughout the world, and the coerced conversion would have been endless. The U.S. tried. It removed the legal tender privilege from the Mexican coins and decreed the new U.S. coins be used for taxes, government salaries, and other government payments. But this time the Filipinos happily used the old Mexican coins as money, while the U.S. silver coins disappeared from circulation into payment of taxes and transactions to the United States. The War Department was beside itself. How could it drive Mexican silver coinage out of the Philippines? In desperation, it turned to the indefatigable Conant, but Conant couldn't join the colonial government in the Philippines because he had just been appointed to a more far-flung presidential commission on international exchange for pressuring Mexico and China to go on a similar gold exchange standard. Hollander, fresh from his Puerto Rican triumph, was ill. Who else? Conant, Hollander, and several leading bankers told the War Department they could recommend no one for the job, so new was the profession of technical expertise in monetary imperialism. But there was one more hope. The other pro-cartelist and financial imperialist, Cornell's Jeremiah W. Jenks, a fellow member with Conant of President Roosevelt's new Commission on International Exchange, or CIE. Jenks had already paved the way for Conant by visiting English and Dutch colonies in the Far East in 1901 to gain information about running the Philippines. Jenks finally came up with a name, his former graduate student at Cornell, Edwin W. Kemmerer. Young Kemmerer went to the Philippines from 1903 to 1906 to implement the Conant Plan. Based on the theories of Jenks and Conant, and on his own experience in the Philippines, Kemmerer went on to teach at Cornell and then at Princeton, and gained fame throughout the 1920s as the, quote, money doctor, busily imposing the gold exchange standard on country after country abroad. Relying on Conant's behind-the-scenes advice, Kemmerer and his associates finally came out with a successful scheme to drive out the Mexican silver coins. It was a plan that relied heavily on government coercion. The United States imposed a legal prohibition on the importation of the Mexican coins, followed by severe taxes on any private Philippine transactions daring to use the Mexican currency. Luckily for the planners, their scheme was aided by a large-scale demand at the time for Mexican silver in northern China, which absorbed silver from the Philippines or that would have been smuggled into the islands. The U.S. success was aided by the fact that the new U.S. silver coins, perceptively called, quote, Conants by the Filipinos, were made up to look very much like the cherished old Mexican coins. By 1905, force, luck, and trickery had prevailed, and the Conants, worth 50 cents in U.S. money, were the dominant currency in the Philippines. Soon, the U.S. authorities were confident enough to add token copper coins and paper Conants as well. By 1903, the currency reformers felt emboldened enough to move against the Mexican silver dollar throughout the world. In Mexico itself, U.S. industrialists who wanted to invest there pressured the Mexicans to shift from silver to gold, and they found an ally in Mexico's powerful finance minister, José Limantour. But tackling the Mexican silver peso at home would not be an easy task, for the coin was known and used throughout the world, particularly in China, where it formed the bulk of the circulating coinage. Finally, after three-way talks between United States, Mexican, and Chinese officials, the Mexicans and Chinese were induced to send identical notes to the U.S. Secretary of State, urging the United States to appoint financial advisors to bring about currency reform and stabilized exchange rates with the gold countries. These requests gave President Roosevelt, upon securing congressional approval, the excuse to appoint, in March 1903, a three-man commission on international exchange to bring about currency reform in Mexico, China, and the rest of the silver-using world. The aim was, quote, to bring about a fixed relationship between the monies of the gold standard countries and the present silver-using countries, end quote, in order to foster, quote, export trade and investment opportunities, end quote, in the gold countries and economic development in the silver countries. The three members of the CIE were old friends and like-minded colleagues. Chairman was Hugh H. Hanna of the Indianapolis Monetary Commission. The others were his former chief aide at that commission, Charles A. Conant, and Professor Jeremiah W. Jenks. Conant, as usual, was the major theoretician and finagler. He realized that major opposition to Mexico's and China's going off silver would come from the important Mexican silver industry, and he devised a scheme to get European countries to purchase large amounts of Mexican silver to ease the pain of the shift. In a trip to European nations in the summer of 1903, however, Conant and the CIE found the Europeans less than enthusiastic about making Mexican silver purchases as well as subsidizing U.S. exports and investments in China, a land whose market they too were coveting. In the United States, on the other hand, major newspapers and financial periodicals, prodded by Conant's public relations work, warmly endorsed the new currency scheme. In the meanwhile, however, the United States faced similar currency problems in its two new Caribbean protectorates, Cuba and Panama. Panama was easy. The United States occupied the canal zone and would be importing vast amounts of equipment to build the canal, so it decided to impose the American gold dollar as the currency in the nominally independent Republic of Panama. While the gold dollar was the official currency of Panama, the United States imposed as the actual medium of exchange a new debased silver peso worth 50 cents. Fortunately, the new peso was almost the same in value as the old Colombian silver coin it forcibly displaced, and so, like Puerto Rico, the takeover could go without a hitch. Among the U.S. colonies or protectorates, Cuba proved the toughest nut to crack. Despite all of Conant's ministrations, Cuba's currency remained unreformed. Spanish gold and silver coins, French coins, and U.S. currency all circulated side by side, freely fluctuating in response to supply and demand. Furthermore, similar to the pre-reformed Philippines, a fixed bimetallic exchange rate between the cheaper U.S. and the more valuable Spanish and French coins led the Cubans to return cheaper U.S. coins to the U.S. customs authorities in fees and revenues. Why then did Conant fail in Cuba? In the first place, strong Cuban nationalism resented U.S. plans for seizing control of their currency. Conant's repeated request in 1903 for a Cuban invitation for the CIE to visit the island met stern rejections from the Cuban government. Moreover, the characteristic U.S. military commander in Cuba, Leonard Wood, wanted to avoid giving the Cubans the impression that plans were afoot to reduce Cuba to colonial status. The second objection was economic. The powerful sugar industry in Cuba depended on exports to the United States, and a shift from depreciated silver to higher-valued gold money would increase the cost of sugar exports by an amount Leonard Wood estimated to be about 20%. While the same problem had existed for the sugar planters in Puerto Rico, American economic interests in Puerto Rico and in other countries such as the Philippines favored forcing formerly silver countries onto a gold-based standard so as to stimulate U.S. exports into those countries. In Cuba, on the other hand, there was increasing U.S. investment capital pouring into the Cuban sugar plantations, so that powerful and even dominant U.S. economic interests existed on the other side of the currency reform question. Indeed, by World War I, American investments in Cuban sugar reached the sum of $95 million. Thus, when Charles Conant resumed his pressure for a Cuban gold exchange standard in 1907, he was strongly opposed by the U.S. governor of Cuba, Charles Magoon, who raised the problem of a gold-based standard crippling the sugar planters. The CIE never managed to visit Cuba, and, ironically, Charles Conant died in Cuba in 1915, trying in vain to convince the Cubans of the virtues of the gold exchange standard. The Mexican shift, from silver to gold, was more gratifying to Conant. But here, the reform was effected by Foreign Minister Lee Montour and his indigenous technicians, with the CIE taking a back seat. However, the success of this shift, in the Mexican Currency Reform Act of 1905, was assured by a world rise in the price of silver, starting the following year, which made gold coins cheaper than silver, with Gresham's Law bringing about a successful gold coin currency in Mexico. But the U.S. silver coinage in the Philippines ran into trouble because of the rise in the world silver price. Here, the U.S. silver currency in the Philippines was bailed out by coordinated action by the Mexican government, which sold silver in the Philippines to lower the value of silver sufficiently so that the Conants could be brought back into circulation. The big failure of Conant's CIE monetary imperialism was in China. In 1900, Britain, Japan, and the United States intervened in China to put down the Boxer Rebellion. The three countries thereupon forced defeated China to agree to pay them and all major European powers an indemnity of $333 million. The United States interpreted the treaty as an obligation to pay in gold, but China, on a depreciated silver standard, began to pay in silver in 1903, an action that enraged the three treaty powers. The U.S. minister to China reported that Britain might declare China's payment in silver a violation of the treaty, which would presage military intervention. Emboldened by United States success in the Philippines, Panama, and Mexico, Secretary of War Root sent Jeremiah W. Jenks on a mission to China in early 1904 to try to transform China from a silver to a gold exchange standard. Jenks also wrote to President Roosevelt from China, urging that the Chinese indemnity to the United States from the Boxer Rebellion be used to fund exchange professorships for 30 years. Jenks's mission, however, was a total failure. The Chinese understood the CIE currency scheme all too well. They saw and denounced the seigniorage of the gold exchange standard as an irresponsible and immoral debasement of Chinese currency, an act that would impoverish China while adding to the profits of U.S. banks where seigniorage reserve funds would be deposited. Moreover, the Chinese officials saw that shifting the indemnity from silver to gold would enrich the European governments at the expense of the Chinese economy. They also noted that the CIE scheme would establish a foreign controller of the Chinese currency to impose banking regulations and economic reforms on the Chinese economy. We need not wonder at the Chinese outrage. China's reaction was its own nationalistic currency reform in 1905, to replace the Mexican silver coin with a new Chinese silver coin, the tael. Jenks's ignominious failure in China put an end to any formal role for the Commission on International Exchange. An immediately following fiasco blocked the U.S. government's use of economic and financial advisors to spread the gold exchange standard abroad. In 1905, the State Department hired Jacob Hollander to move another of its Latin American client states, the Dominican Republic, onto the gold exchange standard. When Hollander accomplished this task by the end of the year, the State Department asked the Dominican government to hire Hollander to work out a plan for financial reform, including a U.S. loan and a customs service run by the United States to collect taxes for repayments of the loan. Hollander, son-in-law of prominent Baltimore merchant Abraham Hutzler, used his connection with Kuhn Leb and Company to place Dominican bonds with that investment bank. Hollander also engaged happily in double-dipping for the same work, collecting fees for the same job from the State Department and from the Dominican government. When this peccadillo was discovered in 1911, the scandal made it impossible for the U.S. government to use its own employees and its own funds to push for gold exchange experts abroad. From then on, there was more of a public-private partnership between the U.S. government and the investment bankers, with the bankers supplying their own funds and the State Department supplying goodwill and more concrete resources. Thus, in 1911 and 1912, the United States, over great opposition, imposed a gold exchange standard on Nicaragua. The State Department formally stepped aside but approved Charles Conant's hiring by the powerful investment banking firm of Brown Brothers to bring about a loan and the currency reform. The State Department lent not only its approval to the project, but also its official wires for Conant's and Brown Brothers to conduct the negotiations with the Nicaraguan government. By the time he died in Cuba in 1915, Charles Conant had made himself the chief theoretician and practitioner of the gold exchange and the economic imperialist movements. Aside from his successes in the Philippines, Panama, and Mexico, and his failures in Cuba and China, Conant led in pushing for gold exchange reform and gold dollar imperialism in Liberia, Bolivia, Guatemala, and Honduras. His magnum opus in favor of the gold exchange standard, the two-volume The Principles of Money and Banking in 1905, as well as his path-breaking success in the Philippines, was followed by a myriad of books, articles, pamphlets, and editorials, always backed up by his personal propaganda efforts. Particularly interesting were Conant's arguments in favor of a gold exchange standard, rather than a genuine gold coin standard. A straight gold coin standard, Conant believed, did not provide a sufficient amount of gold to provide for the world's monetary needs. Hence, by tying the existing silver standard in the undeveloped countries to gold, the, quote, shortage of gold could be overcome, and also the economies of the undeveloped countries could be integrated into those of the dominant imperial power. All this could only be done if the gold exchange standard were, quote, designed and implemented by careful government policy, end quote. But of course, Conant himself and his friends and disciples always stood ready to advise and provide such implementation. In addition, adopting a government-managed gold exchange standard was superior to either genuine gold or bimetallism because it left each state the flexibility of adapting its currency to local needs. As Conant asserted, quote, it leaves each state free to choose the means of exchange which conform best to its local conditions. Rich nations are free to choose gold, nations less rich silver, and those whose financial methods are most advanced are free to choose paper. End quote. It is interesting that for Conant, paper was the most, quote, advanced form of money. It is clear that the devotion to the gold standard of Conant and his colleagues was only to a debased and inflationary standard, controlled and manipulated by the U.S. government, with gold really serving as a facade of allegedly hard money. And one of the critical forms of government manipulation and control in Conant's proposed system was the existence and active functioning of a central bank. As a founder of the, quote, science of financial advising to governments, Conant, followed by his colleagues and disciples, not only pushed a gold exchange standard wherever he could do so, but also advocated a central bank to manage and control that standard. As Emily Rosenberg points out, quote, Conant thus did not neglect one of the major revolutionary changes implicit in his system, a new, important role for a central bank as a currency stabilizer. Conant strongly supported the American banking reform that culminated in the Federal Reserve System, and American financial advisors who followed Conant would spread central banking systems, along with gold standard currency reforms, to the countries they advised. End quote. Along with a managed gold exchange standard would come, as replacement for the old free trade, non-managed gold coin standard, a world of imperial currency blocks, which, quote, would necessarily come into being as lesser countries deposited their gold stabilization funds in the banking systems of more advanced countries, end quote. New York and London banks, in particular, shaped up as the major reserve fund holders in the developing New World monetary order. It is no accident that the United States' major financial and imperial rival, Great Britain, which was pioneering and imposing gold exchange standards in its own colonial area at this time, built upon this experience to impose a gold exchange standard, marked by all European currencies pyramiding on top of British inflation during the 1920s. That disastrous inflationary experiment led straight to the worldwide banking crash and the general shift to fiat paper monies in the early 1930s. After World War II, the United States took up the torch of a world gold exchange standard at Bretton Woods, with the dollar replacing the pound sterling in a worldwide inflationary system that lasted approximately 25 years. Nor should it be thought that Charles A. Conant was the purely disinterested scientist he claimed to be. His currency reforms directly benefited his investment banker employers. Thus, Conant was treasurer from 1902 to 1906 of the Morgan-run Morton Trust Company of New York, and it was surely no coincidence that Morton Trust was the bank that held the reserve funds for the governments of the Philippines, Panama, and the Dominican Republic after their respective currency reforms. In the Nicaragua negotiations, Conant was employed by the investment bank of Brown Brothers, and in pressuring other countries, he was working for Spire and Company and other investment bankers. After Conant died in 1915, there were few to pick up the mantle of foreign financial advising. Hollander was in disgrace after the Dominican debacle. Jenks was aging and lived in the shadow of his China failure, but the State Department did appoint Jenks to serve as a director of the Nicaraguan National Bank in 1917, and also hired him to study the Nicaraguan financial picture in 1925. But the true successor of Conant was Edwin W. Kemmerer, the quote, money doctor. After his Philippine experience, Kemmerer joined his old professor Jenks at Cornell, and then moved to Princeton in 1912, publishing his book Modern Currency Reforms in 1916. As the leading foreign financial advisor of the 1920s, Kemmerer not only imposed central banks and a gold exchange standard on third world countries, but he also got them to levy higher taxes. Kemmerer, too, combined his public employment with service to leading international bankers. During the 1920s, Kemmerer worked as banking expert for the U.S. government's Dawes Commission, headed special financial advisory missions to more than a dozen countries, and was kept on a handsome retainer by the distinguished investment banking firm of Dillon Read from 1922 to 1929. In that era, Kemmerer and his mentor Jenks were the only foreign currency reform experts available for advising. In the late 1920s, Kemmerer helped establish a chair of international economics at Princeton, which he occupied, and from which he could train students like Arthur N. Young and William W. Cumberland. In the mid-1920s, the money doctor served as president of the American Economic Association. Jacob Schiff ignites the drive for a central bank. The defeat of the Fowler Bill for a broader asset currency and branch banking in 1902, coupled with the failure of Treasury Secretary Shaw's attempts of 1903 to 1905 to use the Treasury as a central bank, led the big bankers and their economist allies to adopt a new solution: the franc imposition of a central bank in the United States. The campaign for a central bank was kicked off by a fateful speech in January 1906 by the powerful Jacob H. Schiff, head of the Wall Street investment bank of Kuhn, Loeb and Company, before the New York Chamber of Commerce. Schiff complained that, in the autumn of 1905, when, quote, the country needed money, the Treasury, instead of working to expand the money supply, reduced government deposits in the national banks, thereby precipitating a financial crisis, a, quote, disgrace in which the New York clearinghouse banks had been forced to contract their loans drastically, sending interest rates sky high. A, quote, elastic currency for the nation was therefore imperative, and Schiff urged the New York Chamber's Committee on Finance to draw up a comprehensive plan for a modern banking system to provide for an elastic currency. A colleague who had already been agitating for a central bank behind the scenes was Schiff's partner, Paul Moritz Warburg, who had suggested the plan to Schiff as early as 1903. Warburg had emigrated from the German investment firm of M. Warburg and Company in 1897, and before long his major function at Kuhn-Loeb was to agitate to bring the blessings of European central banking to the United States. It took less than a month for the Finance Committee of the New York Chamber to issue its report, but the bank reformers were furious, denouncing it as remarkably ignorant. When Frank A. Vanderlip of Rockefeller's flagship bank, the National City Bank of New York, reported on this development, his boss, James Stillman, suggested that a new 5-man special commission be set up by the New York Chamber to come back with a plan for currency reform. In response, Vanderlip proposed that the 5-man commission consist of himself, Schiff, J.P. Morgan, George Baker of the First National Bank of New York, Morgan's closest and longest associate, and former Secretary of the Treasury Lyman Gage, now president of the Rockefeller-controlled U.S. Trust Company. Thus, the commission would consist of 2 Rockefeller men, Vanderlip and Gage, 2 Morgan men, Morgan and Baker, and 1 representative from Kuhn-Loeb. Only Vanderlip was available to serve, however, so the commission had to be redrawn. In addition to Vanderlip, beginning in March 1906, there sat, instead of Schiff, his close friend Isidor Straus, a director of R.H. Macy & Company. Instead of Morgan and Baker, there now served 2 Morgan men, Dumont Clark, president of the American Exchange National Bank, and a personal advisor to J.P. Morgan, and Charles A. Conant, treasurer of Morton & Company. The 5th man was a veteran of the Indianapolis Monetary Convention, John Claflin of H.B. Claflin & Company, a large integrated wholesaling concern. Coming on board as secretary of the new currency committee was Vanderlip's old friend Joseph French Johnson, now of New York University, who had been calling for a central bank since 1900. The commission used the old Indianapolis questionnaire technique, acquiring legitimacy by sending out a detailed questionnaire on currency to a number of financial leaders. With Johnson in charge of mailing and collating the questionnaire replies, Conant spent his time visiting and interviewing the heads of the central banks in Europe. The Special Commission delivered its report to the New York Chamber of Commerce in October 1906. To eliminate instability and the danger of an inelastic currency, the Commission called for the creation of a, quote, central bank of issue under the control of the government, end quote. In keeping with other bank reformers, such as Professor Abram Piatt Andrew of Harvard University, Thomas Nixon Carver of Harvard, and Albert Strauss, partner of J.P. Morgan and Company, the commission was scornful of Secretary Shaw's attempt to use the Treasury as central bank. Shaw was particularly obnoxious because he was still insisting, in his last annual report of 1906, that the Treasury, under his aegis, had constituted a, quote, great central bank. The commission, along with the other reformers, denounced the Treasury for overinflating by keeping interest rates excessively low. A central bank, in contrast, would have much larger capital and undisputed control over the money market, and thus would be able to manipulate the discount rate effectively to keep the economy under proper control. The important point, declared the committee, is that there be, quote, centralization of financial responsibility, end quote. In the meantime, short of establishing a central bank, the committee urged that, at the least, the national bank's powers to issue notes should be expanded to include being based on general assets as well as government bonds. After drafting and publishing this, quote, currency report, the reformers used the report as the lever for expanding the agitation for a central bank and broader note issue powers to other corporate and financial institutions. The next step was the powerful American Bankers Association, or ABA. In 1905, the Executive Council of the ABA had appointed a currency committee which, the following year, recommended an emergency assets currency that would be issued by a federal commission, resembling an embryonic central bank. In a tumultuous plenary session of the ABA convention in October 1906, the ABA rejected this plan, but agreed to appoint a 15-man currency commission that was instructed to meet with the New York Chamber's Currency Committee and attempt to agree on appropriate legislation. Particularly prominent on the ABA Currency Commission were Arthur Reynolds, president of the Des Moines National Bank, close to the Morgan-oriented Des Moines Regency, and brother of the prominent Chicago banker George M. Reynolds, formerly of Des Moines and then president of the Morgan-oriented Continental National Bank of Chicago, and the powerful chairman of the Executive Council of the ABA. James V. Forgan, president of the Rockefeller-run First National Bank of Chicago, and close friend of Jacob Schiff of Kuhn-Leb, as well as of Vanderlip. Joseph T. Talbert, vice president of the Rockefeller-dominated Commercial National Bank of Chicago, and soon to become vice president of Rockefeller's flagship bank, the National City Bank of New York. Myron T. Herrick, one of the most prominent Rockefeller politicians and businessmen in the country. Herrick was the head of the Cleveland Society of Savings, and was part of the small team of close Rockefeller business allies who, along with Mark Hanna, bailed out Governor William McKinley from bankruptcy in 1893. Herrick was a previous president of the ABA, and just finished a 2-year stint as governor of Ohio, and was later to become ambassador to France under his old friend and political ally, William Howard Taft, as well as later under President Warren G. Harding, and a recipient of Herrick's political support and financial largesse. And chairman of the ABA Commission, A. Barton Hepburn, president of one of the leading Morgan commercial banks, the Chase National Bank of New York, and author of the well-regarded History of Coinage and Currency in the United States. After meeting with Vanderlip and Conant as the representatives of the New York Chamber of Commerce Committee, the ABA Commission, along with Vanderlip and Conant, agreed on at least the transition demands of the reformers. The ABA Commission presented proposals to the public, the press, and the Congress in December 1906 for a broader asset currency, as well as provisions for emergency issue of banknotes by national banks. But just as sentiment for a broader asset currency became prominent, the bank reformers began to worry about an uncontrolled adoption of such a currency. For that would mean that national bank credit and notes would expand, and that, in the existing system, small state banks would be able to pyramid and inflate credit on top of the national credit, using the expanded national banknotes as their reserves. The reformers wanted a credit inflation controlled by and confined to the large national banks. They most emphatically did not want uncontrolled state bank inflation that would siphon resources to small entrepreneurs and, quote, speculative marginal producers. The problem was aggravated by the accelerated rate of increase in the number of small southern and western state banks after 1900. Another grave problem for the reformers was that commercial paper was a different system from that of Europe. In Europe, commercial paper, and hence bank assets, were two-name notes endorsed by a small group of wealthy acceptance banks. In contrast to this acceptance paper system, commercial paper in the United States was unendorsed single-name paper, with the bank taking a chance on the creditworthiness of the business borrower. Hence, a decentralized financial system in the United States was not subject to big banker control. Worries about the existing system, and hence about uncontrolled asset currency, were voiced by the top bank reformers. Thus, Vanderlip expressed concern that, quote, there are so many state banks that might count these national banknotes in their reserves, end quote. Schiff warned that, quote, it would prove unwise, if not dangerous, to clothe 6,000 banks or more with the privilege to issue independently a pure credit currency, end quote. And, from the Morgan side, a similar concern was voiced by Victor Morawetz, the powerful chairman of the board of the Atchison, Topeka, and Santa Fe Railroad. Taking the lead in approaching this problem of small banks and decentralization was Paul Moritz Warburg of Kuhn-Leb, fresh from his banking experience in Europe. In January 1907, Warburg began what would become years of tireless agitation for central banking with two articles, Defects and Needs of Our Banking System, and A Plan for a Modified Central Bank. Calling openly for a central bank, Warburg pointed out that one of the important functions of such a bank would be to restrict the eligibility of bank assets to be used for expansion of bank deposits. Presumably, too, the central bank could move to require banks to use acceptance paper or otherwise try to create an acceptance market in the United States. By the summer of 1907, Bankers Magazine was reporting a decline in influential banker support for broadening asset currency, and a strong move toward the, quote, central bank project. Bankers Magazine noted as a crucial reason the fact that asset currency would be expanding bank services to, quote, small producers and dealers. The Panic of 1907 and mobilization for a central bank. A severe financial crisis, the Panic of 1907, struck in early October. Not only was there a general recession and contraction, but the major banks in New York and Chicago were, as in most other depressions in American history, allowed by the government to suspend specie payments, that is, to continue in operation while being relieved of their contractual obligation to redeem their notes and deposits in cash or in gold. While the Treasury had stimulated inflation during 1905 to 1907, there was nothing it could do to prevent suspensions of payments, or to alleviate, quote, the competitive hoarding of currency, end quote, after the panic. That is, the attempt to demand cash in return for increasingly shaky banknotes and deposits. Very quickly after the panic, banker and business opinion consolidated on behalf of a central bank, an institution that could regulate the economy and serve as a lender of last resort to bail banks out of trouble. The reformers now faced a twofold task: hammering out details of the new central bank, and more important, mobilizing public opinion on its behalf. The first step in such mobilization was to win the support of the nation's academics and experts. The task was made easier by the growing alliance and symbiosis between academia and the power elite. Two organizations that proved particularly useful for this mobilization were the American Academy of Political and Social Science, the AAPSS, of Philadelphia, and the Academy of Political Science, the APS, of Columbia University, both of which included in their ranks leading corporate liberal businessmen, financiers, attorneys, and academics. Nicholas Murray Butler, the highly influential president of Columbia University, explained that the Academy of Political Science, quote, is an intermediary between the scholars and the men of affairs, those who may perhaps be said to be amateurs in scholarship, end quote. Here, he pointed out, was where they, quote, come together. It is not surprising, then, that the American Academy of Political and Social Science, the American Association for the Advancement of Science, and Columbia University held 3 symposia during the winter of 1907 to 1908, each calling for a central bank, and thereby disseminating the message of a central bank to a carefully selected elite public. Not surprising, too, was that E.R.A. Seligman was the organizer of the Columbia Conference, gratified that his university was providing a platform for leading bankers and financial journalists to advocate a central bank. Especially, he noted, because, quote, it is proverbially difficult in a democracy to secure a hearing for the conclusions of experts, end quote. Then, in 1908, Seligman collected the addresses into a volume, The Currency Problem. Professor Seligman set the tone for the Columbia gathering in his opening address. The Panic of 1907, he alleged, was moderate because its effects had been tempered by the growth of industrial trusts, which provided a more controlled and, quote, more correct adjustment of present investment to future needs, end quote, than would a, quote, horde of small competitors, end quote. In that way, Seligman displayed no comprehension of how competitive markets facilitate adjustments. One big problem, however, still remained for Seligman. The horde of small competitors, for whom Seligman had so much contempt, still prevailed in the field of currency and banking. The problem was that the banking system was still decentralized. As Seligman declared, quote, even more important than the inelasticity of our note issue is its decentralization. The struggle, which has been victoriously fought out everywhere else in creating trusts, must be undertaken here in earnest and with vigor, end quote. The next address was that of Frank Vanderlip. To Vanderlip, in contrast to Seligman, the Panic of 1907 was, quote, one of the great calamities of history, end quote, the result of a decentralized, competitive American banking system, with 15,000 banks all competing vigorously for control of cash reserves. The terrible thing is that, quote, each institution stands alone, concerned first with its own safety, and using every endeavor to pile up reserves without regard, end quote, to the effect of such actions on other banking institutions. This backward system had to be changed to follow the lead of other great nations, where a central bank is able to mobilize and centralize reserves and create an elastic currency system. Putting the situation in virtually Marxian terms, Vanderlip declared that the alien external power of the free and competitive market must be replaced by central control following modern, allegedly scientific principles of banking. Thomas Wheelock, editor of the Wall Street Journal, then rung the changes on the common theme by applying it to the volatile call loan market in New York. The market is volatile, Wheelock claimed, because the small country banks are able to lend on that market, and their deposits in New York banks then rise and fall in uncontrolled fashion. Therefore, there must be central corporate control over country bank money in the call loan market. A. Barton Hepburn, head of Morgan's Chase National Bank, came next, and spoke of the great importance of having a central bank that would issue a monopoly of banknotes. It was particularly important that the central bank be able to discount the assets of national banks, and thus supply an elastic currency. The last speaker was Paul Warburg, who lectured his audience on the superiority of European over American banking, particularly in 1, having a central bank as against decentralized American banking, and 2, his old hobby horse, enjoying, quote, modern acceptance paper instead of single-name promissory notes. Warburg emphasized that these two institutions must function together. In particular, tight government central bank control must replace competition and decentralization. Quote, small banks constitute a danger. End quote. The other two symposia were very similar. At the AAPSS Symposium in Philadelphia in December 1907, several leading investment bankers and comptroller of the currency William B. Ridgely came out in favor of a central bank. It was no accident that members of the AAPSS's Advisory Committee on Currency included A. Barton Hepburn, Morgan attorney and statesman Elihu Root, Morgan's longtime personal attorney Francis Lyde Stetson, and J.P. Morgan himself. Meanwhile, the AAAS Symposium in January 1908 was organized by none other than Charles A. Conant, who happened to be chairman of the AAAS's Social and Economic section for the year. Speakers included Columbia economist J.B. Clark, Frank Vanderlip, Conant, and Vanderlip's friend George E. Roberts, head of the Rockefeller-oriented Commercial National Bank of Chicago, who would later wind up at the National City Bank. All in all, the task of the bank reformers was well summed up by J.R. Duffield, secretary of the Bankers Publishing Company, in January 1908. Quote, it is recognized generally that before legislation can be had, there must be an educational campaign carried on, first among the bankers, and later among commercial organizations, and finally among the public as a whole. End quote. That strategy was well underway. During the same month, the legislative lead in banking reform was taken by the formidable Senator Nelson W. Aldrich, Republican from Rhode Island, head of the Senate Finance Committee, and, as the father-in-law of John D. Rockefeller, Jr., Rockefeller's man in the U.S. Senate. He introduced the Aldrich Bill, which focused on a relatively minor interbank dispute about whether and on what basis the national banks could issue special emergency currency. A compromise was finally hammered out and passed as the Aldrich-Vreeland Act in 1908. But the important part of the Aldrich-Vreeland Act, which got very little public attention but was perceptively hailed by the bank reformers, was the establishment of a national monetary commission that would investigate the currency question and suggest proposals for comprehensive banking reform. Two enthusiastic comments on the Monetary Commission were particularly perceptive and prophetic. One was that of Sereno S. Pratt of the Wall Street Journal. Pratt virtually conceded that the purpose of the commission was to swamp the public with supposed expertise and thereby, quote, educate them into supporting banking reform. Quote, "Reform can only be brought about by educating the people up to it, and such education must necessarily take much time. In no other way can such education be effected more thoroughly and rapidly than by means of a commission that would make an international study of the subject and present an exhaustive report, which could be made the basis for an intelligent agitation." End quote. The results of the, quote, "study" were of course predetermined, as would be the membership of the allegedly impartial study commission. Another function of the commission, as stated by Festus J. Wade, St. Louis banker and member of the Currency Commission of the American Bankers Association, was to, quote, "keep the financial issue out of politics," end quote, and put it squarely in the safe custody of carefully selected, quote, "experts." Thus, the National Monetary Commission, or NMC, was the apotheosis of the clever commission concept, launched in Indianapolis a decade earlier. Aldrich lost no time setting up the NMC, which was launched in June 1908. The official members were an equal number of senators and representatives, but these were mere window dressing. The real work would be done by the copious staff, appointed and directed by Aldrich, who told his counterpart in the House, Cleveland Republican Theodore Burton, quote, "My idea is, of course, that everything shall be done in the most quiet manner possible, and without any public announcement." End quote. From the beginning, Aldrich determined that the NMC would be run as an alliance of Rockefeller, Morgan, and Kuhn-led people. The two top expert posts advising or joining the commission were both suggested by Morgan leaders. On the advice of J.P. Morgan, seconded by Jacob Schiff, Aldrich picked as his top advisor the formidable Henry P. Davison, Morgan partner, founder of Morgan's Bankers Trust Company, and vice president of George F. Baker's First National Bank of New York. It would be Davison who, on the outbreak of World War I, would rush to England to cement J.P. Morgan and Company's close ties with the Bank of England, and to receive an appointment as monopoly underwriter for all British and French government bonds to be floated in the United States for the duration of the war. For technical economic expertise, Aldrich accepted the recommendation of President Roosevelt's close friend and fellow Morgan man, Charles Eliot, president of Harvard University, who urged the appointment of Harvard economist A. Piet Andrew. And an ex officio commission member chosen by Aldrich himself was George M. Reynolds, president of the Rockefeller-oriented Continental National Bank of Chicago. The NMC spent the fall touring Europe and conferring on information and strategy with heads of large European banks and central banks. As director of research, A. Piet Andrew began to organize American banking experts and to commission reports and studies. The National City Bank's Foreign Exchange Department was commissioned to write papers on bankers' acceptances and foreign debt, while Warburg and Bankers Trust official Fred Kent wrote on the European discount market. Having gathered information and advice in Europe in the fall of 1908, the NMC was ready to go into high gear by the end of the year. In December, the Commission hired the inevitable Charles A. Conant for research, public relations, and agitprop. Behind the facade of the congressmen and senators on the Commission, Senator Aldrich began to form and expand his inner circle, which soon included Warburg and Vanderlip. Warburg formed around him a sub-circle of friends and acquaintances from the Currency Committee of the New York Merchants Association, headed by Irving T. Bush, and from the top ranks of the American Economic Association, to whom he had delivered an address advocating central banking in December 1908. Warburg met and corresponded frequently with leading academic economists advocating banking reform, including E.R.A. Seligman, Thomas Nixon Carver of Harvard, Henry R. Seeger of Columbia, Davis R. Dewey, historian of banking at MIT, longtime secretary-treasurer of the AEA, and brother of the progressive philosopher John Dewey. Oliver M. W. Sprague, professor of banking at Harvard, of the Morgan-connected Sprague family, Frank W. Taussig of Harvard, and Irving Fisher of Yale. During 1909, however, the reformers faced an important problem. They had to bring such leading bankers as James B. Forgan, head of the Rockefeller-oriented First National Bank of Chicago, solidly into line in support of a central bank. It was not that Forgan objected to centralized reserves or a lender of last resort. Quite the contrary. It was rather that Forgan recognized that, under the national banking system, large banks such as his own were already performing quasi-central banking functions with their own country bank depositors, and he didn't want his bank deprived of such functions by a new central bank. The bank reformers, therefore, went out of their way to bring such men as Forgan into enthusiastic support for the new scheme. In his presidential address to the powerful American Bankers Association in mid-September 1909, George M. Reynolds not only came out flatly in favor of a central bank in America, to be modeled after the German Reichsbank, he also assured Forgan and others that such a central bank would act as depository of reserves only for the large national banks in the Central Reserve cities, while the national banks would continue to hold deposits for the country banks. Mollified, Forgan held a private conference with Aldrich's inner circle and came fully on board for the central bank. As an outgrowth of Forgan's concerns, the reformers decided to cloak their new central bank in a spurious veil of, quote, regionalism and, quote, decentralism, through establishing regional reserve centers that would provide the appearance of virtually independent regional central banks to cover the reality of an orthodox European central bank monolith. As a result, noted railroad attorney Victor Morowitz made his famous speech in November 1909, calling for regional banking districts under the ultimate direction of one central control board. Thus, reserves and note issue would be supposedly decentralized in the hands of the regional reserve banks, while they would really be centralized and coordinated by the Central Control Board. This, of course, was the scheme eventually adopted in the Federal Reserve System. On September 14th, at the same time as Reynolds' address to the nation's bankers, another significant address took place. President William Howard Taft, speaking in Boston, suggested that the country seriously consider establishing a central bank. Taft had been close to the reformers, especially his Rockefeller-oriented friends Aldrich and Burton, since 1900. But the business press understood the great significance of this public address, that it was, as the Wall Street Journal put it, a crucial step, quote, toward removing the subject from the realm of theory to that of practical politics, end quote. 1 week later, a fateful event in American history occurred. The banking reformers moved to escalate their agitation by creating a virtual government bank press complex to drive through a central bank. On September 22, 1909, the Wall Street Journal took the lead in this development by beginning a notable, front-page, 14-part series on, quote, a central bank of issue, end quote. These were unsigned editorials by the Journal, but they were actually written by the ubiquitous Charles A. Conant, from his vantage point as salaried chief propagandist of the U.S. government's National Monetary Commission. The series was a summary of the reformers' position, also going out of the way to assure the Forgans of this world that the new central bank, quote, would probably deal directly only with the larger national banks, leaving it for the latter to rediscount for their more remote correspondents, end quote. To the standard arguments for a central bank, quote, elasticity of the money supply, protecting bank reserves by manipulating the discount rate and the international flow of gold, and combating crisis by bailing out individual banks, Conant added a Conant twist. The importance of regulating interest rates and the flow of capital in a world marked by surplus capital. Government debt would, for Conant, provide the important function of sopping up surplus capital, that is, providing profitable outlets for savings by financing government expenditures. The Wall Street Journal series inaugurated a shrewd and successful campaign by Conant to manipulate the nation's press and get it behind the idea of a central bank. Building on his experience in 1898, Conant, along with Aldrich's secretary, Arthur B. Shelton, prepared abstracts of commission materials for the newspapers during February and March of 1910. Soon Shelton recruited J.P. Gavitt, head of the Washington Bureau of the Associated Press, to scan commission abstracts, articles, and forthcoming books for, quote, newsy paragraphs to catch the eye of newspaper editors. The academic organizations proved particularly helpful to the NMC, lending their cloak of disinterested expertise to the endeavor. In February, Robert E. Ely, secretary of the APS, proposed to Aldrich that a special volume of its Proceedings be devoted to banking and currency reform, to be published in cooperation with the NMC, in order to, quote, popularize in the best sense some of the valuable work of the Commission, end quote. And yet, Ely had the gall to add that, even though the APS would advertise the NMC's arguments and conclusions, it would retain its, quote, objectivity by avoiding its own specific policy recommendations. As Ely put it, quote, we shall not advocate a central bank, but we shall only give the best results of your work in condensed form and untechnical language, end quote. The AAPSS, too, weighed in with its own special volume, Banking Problems, in 1910, featuring an introduction by A. Piet Andrew of Harvard and the NMC, and articles by veteran bank reformers such as Joseph French Johnson, Horace White, and Morgan Bankers Trust official Fred I. Kent. But most of the articles were from leaders of Rockefeller's National City Bank of New York, including George E. Roberts, a former Chicago banker and U.S. Mint official about to join National City. Meanwhile, Paul M. Warburg capped his lengthy campaign for a central bank in a famous speech to the New York YMCA on March 23rd, on, quote, a United Reserve Bank for the United States. Warburg basically outlined the structure of his beloved German Reichsbank, but he was careful to begin his talk by noting a recent poll in the Banking Law Journal that 60% of the nation's bankers favored a central bank, provided it was, quote, not controlled by Wall Street or any monopolistic interest, end quote. To calm this fear, Warburg insisted that, semantically, the new Reserve Bank not be called a central bank, and that the Reserve Bank's governing board be chosen by government officials, merchants, and bankers, with bankers, of course, dominating the choices. He also provided a distinctive Warburg twist by insisting that the Reserve Bank replace the hated single-name paper system of commercial credit dominant in the United States by the European system, whereby a Reserve Bank provided a guaranteed and subsidized market for two named commercial paper endorsed by acceptance banks. In this way, the United Reserve Bank would correct the, quote, complete lack of modern bills of exchange, end quote, that is, acceptances, in the United States. Warburg added that the entire idea of a free and self-regulating market was obsolete, particularly in the money market. Instead, the action of the market must be replaced by, quote, the best judgment of the best experts, end quote. And guess who was slated to be one of the best of those best experts? The greatest cheerleader for the Warburg Plan, and the man who introduced the APS's Reform of the Currency in 1911, the volume on banking reform featuring Warburg's speech, was Warburg's kinsman and member of the Seligman investment banking family, Columbia economist E.R.A. Seligman. So delighted was the Merchants Association of New York with Warburg's speech that it distributed 30,000 copies during the spring of 1910. Warburg had paved the way for this support by regularly meeting with the Currency Committee of the Merchants Association since October 1908, and his efforts were aided by the fact that the resident expert for that committee was none other than Joseph French Johnson. At the same time, in the spring of 1910, the numerous research volumes published by the NMC poured onto the market. The object was to swamp public opinion with a parade of impressive, analytic, and historical scholarship, all allegedly, quote, scientific and, quote, value-free, but all designed to aid in furthering the common agenda of a central bank. Typical was E.W. Kemmerer's mammoth statistical study of seasonal variations in the demand for money. Stress was laid on the problem of the, quote, inelasticity of the supply of cash. In particular, the difficulty of expanding that supply when needed. While Kemmerer felt precluded from spelling out the policy implications, establishing a central bank, in the book, his acknowledgments in the preface to Fred Kent and the inevitable Charles Conant were a tip-off to the cognoscenti, and Kemmerer himself disclosed them in his address to the Academy of Political Science the following November. Now that the theoretical and scholarly groundwork had been laid, by the latter half of 1910, it was time to formulate a concrete, practical plan and put on a mighty putsch on its behalf. In Reform of the Currency, published by the APS, Warburg made the point with crystal clarity. Quote, "Advance is possible only by outlining a tangible plan," end quote, that would set the terms of the debate from then on. The tangible plan phase of the central bank movement was launched by the ever-pliant APS, which held a monetary conference in November 1910, in conjunction with the New York Chamber of Commerce and the Merchants Association of New York. The members of the NMC were the guests of honor at this conclave, and delegates were chosen by governors of 22 states, as well as presidents of 24 chambers of commerce. Also attending were a large number of economists, monetary analysts, and representatives of most of the top banks in the country. Attendants at the conference included Frank Vanderlip, Elihu Root, Thomas W. Lamont of the Morgans, Jacob Schiff, and J.P. Morgan. The formal sessions of the conference were organized around papers by Kemmerer, Laughlin, Johnson, Bush, Warburg, and Conant, and the general atmosphere was that bankers and businessmen were to take their general guidance from the attendant scholars. As James B. Forgan, Chicago banker who was now solidly in the central banking camp, put it, quote, "Let the theorists, those who can study from past history and from present conditions the effect of what we are doing, lay down principles for us, and let us help them with the details." End quote. C. Stuart Patterson pointed to the great lessons of the Indianapolis Monetary Commission, and the way in which its proposals triumphed in action because, quote, "we went home and organized an aggressive and active movement." End quote. Patterson then laid down the marching orders of what this would mean concretely for the assembled troops. Quote, "That is just what you must do in this case. You must uphold the hands of Senator Aldrich. You have got to see that the bill which he formulates obtains the support of every part of the country." End quote. With the New York Monetary Conference over, it was now time for Aldrich, surrounded by a few of the topmost leaders of the financial elite, to go off in seclusion and hammer out a detailed plan around which all parts of the central bank movement could rally. Someone in the Aldrich inner circle, probably Morgan partner Henry P. Davison, got the idea of convening a small group of top leaders in a super-secret conclave to draft the central bank bill. On November 22, 1910, Senator Aldrich, with a handful of companions, set forth in a privately chartered railroad car from Hoboken, New Jersey, to the coast of Georgia, where they sailed to an exclusive retreat, the Jekyll Island Club on Jekyll Island, Georgia. Facilities for their meeting were arranged by club member and co-owner J.P. Morgan. The cover story released to the press was that this was a simple duck hunting expedition, and the conferees took elaborate precautions on the trips there and back to preserve their secrecy. Thus, the attendees addressed each other only by first name, and the railroad car was kept dark and closed off from reporters or other travelers on the train. One reporter apparently caught on to the purpose of the meeting, but was in some way persuaded by Henry P. Davison to maintain silence. The conferees worked for a solid week at Jekyll Island to hammer out the draft of the Federal Reserve Bill. In addition to Aldrich, the conferees included Henry P. Davison, Morgan partner, Paul Warburg, whose address in the spring had greatly impressed Aldrich, Frank A. Vanderlip, vice president of the National City Bank of New York, and finally, A. Piet Andrew, head of the NMC staff, who had recently been made Assistant Secretary of the Treasury by President Taft. After a week of meetings, the 6 men had forged a plan for a central bank, which eventually became the Aldrich Bill. Vanderlip acted as secretary of the meeting and contributed the final writing. The only substantial disagreement was tactical, with Aldrich attempting to hold out for a straightforward central bank on the European model, while Warburg and the other bankers insisted that the reality of central control be cloaked in the politically palatable camouflage of, quote, decentralization. It is amusing that the bankers were the more politically astute, while the politician Aldrich wanted to waive political considerations. Warburg and the bankers won out, and the final draft was basically the Warburg Plan with a decentralized patina taken from Marowitz. The financial power elite now had a bill. The significance of the composition of the small meeting must be stressed. 2 Rockefeller men, Aldrich and Vanderlip, 2 Morgans, Davison and Norton, 1 Kuhn-Leb person, Warburg, and 1 economist friendly to both camps, Andrew. After working on some revisions of the Jekyll Island draft with Forgan and George Reynolds, Aldrich presented the Jekyll Island draft as the Aldrich Plan to the full NMC in January 1911. But here, an unusual event occurred. Instead of quickly presenting this Aldrich bill to the Congress, its drafters waited for a full year, until January 1912. Why the unprecedented year's delay? The problem was that the Democrats swept the congressional elections in 1910, and Aldrich, disheartened, decided not to run for re-election to the Senate the following year. The Democratic triumph meant that the reformers had to devote a year of intensive agitation to convert the Democrats and to intensify propaganda to the rest of banking, business, and the public. In short, the reformers needed to regroup and accelerate their agitation. The final phase. Coping with the Democratic ascendancy. The final phase of the drive for a central bank began in January 1911. At the previous January's meeting of the National Board of Trade, Paul Warburg had put through a resolution setting aside January 18, 1911, as a, quote, monetary day, devoted to a businessmen's monetary conference. This conference, run by the National Board of Trade, and featuring delegates from metropolitan, mercantile organizations from all over the country, had C. Stewart Patterson as its chairman. The New York Chamber of Commerce, the Merchants Association of New York, and the New York Produce Exchange, each of which had been pushing for banking reform for the previous 5 years, introduced a joint resolution to the Monetary Conference supporting the Aldrich Plan, and proposing the establishment of a new, quote, Businessmen's Monetary Reform League, to lead the public struggle for a central bank. After a speech in favor of the plan by A. Piet Andrew, the entire conference adopted the resolution. In response, C. Stewart Patterson appointed none other than Paul M. Warburg to head a committee of 7 to establish the Reform League. The Committee of 7 shrewdly decided, following the lead of the old Indianapolis Convention, to establish the National Citizens League for the creation of a sound banking system in Chicago rather than in New York, where the control really resided. The idea was to acquire the bogus patina of a, quote, grassroots, heartland operation and to convince the public that the League was free of dreaded Wall Street control. As a result, the official heads of the League were Chicago businessmen John V. Farwell and Harry A. Wheeler, president of the U.S. Chamber of Commerce. The director was University of Chicago monetary economist J. Lawrence Laughlin, assisted by his former student, Professor H. Parker Willis. In keeping with its Midwestern aura, most of the directors of the Citizens League were Chicago non-banker industrialists, men such as B. E. Sonny of the Chicago Telephone Company, Cyrus McCormick of International Harvester, both companies in the Morgan ambit, John G. Shedd of Marshall Field and Company, Frederick A. Delano of the Wabash Railroad Company, Rockefeller-controlled, and Julius Rosenwald of Sears, Roebuck. Over a decade later, however, H. Parker Willis frankly conceded that the Citizens League had been a propaganda organ of the nation's bankers. The Citizens League swung into high gear during the spring and summer of 1911, issuing a periodical, Banking and Reform, designed to reach newspaper editors and subsidizing pamphlets by such pro-reform experts as John Perrin, head of the American National Bank of Indianapolis, and George E. Roberts of the National City Bank of New York. Consultant on the newspaper campaign was H. H. Colsott, former executive committee member of the Indianapolis Monetary Convention. Laughlin himself worked on a book on the Aldrich Plan, to be similar to his own report of 1898 for the Indianapolis Convention. Meanwhile, a parallel campaign was launched to bring the nation's bankers into camp. The first step was to convert the banking elite. For that purpose, the Aldrich Inner Circle organized a closed-door conference of 23 top bankers in Atlantic City in early February, which included several members of the Currency Commission of the American Bankers Association, or ABA, along with bank presidents from 9 leading cities of the country. After making a few minor revisions, the conference warmly endorsed the Aldrich Plan. After this meeting, Chicago banker James B. Forgan, president of the Rockefeller-dominated First National Bank of Chicago, emerged as the most effective banker spokesman for the central bank movement. Not only was his presentation of the Aldrich Plan before the Executive Council of the ABA in May considered particularly impressive, it was especially effective coming from someone who had been a leading critic, if on relatively minor grounds, of the plan. As a result, the top bankers managed to get the ABA to violate its own bylaws and make Forgan chairman of its executive council. At the Atlantic City conference, James Forgan had succinctly explained the purpose of the Aldrich Plan and of the conference itself. As Kolko sums up, quote, "The real purpose of the conference was to discuss winning the banking community over to government control directly by the bankers for their own ends. It was generally appreciated that the Aldrich Plan would increase the power of the big national banks to compete with the rapidly growing state banks, help bring the state banks under control, and strengthen the position of the national banks in foreign banking activities." End quote. By November 1911, it was easy pickings to have the full American Bankers Association endorse the Aldrich Plan. The nation's banking community was now solidly lined up behind the drive for a central bank. However, 1912 and 1913 were years of some confusion and backing and filling, as the Republican Party split between its insurgents and regulars, and the Democrats won increasing control over the federal government, culminating in Woodrow Wilson's gaining the presidency in the November 1912 elections. The Aldrich Plan, introduced into the Senate by Theodore Burton in January 1912, died a quick death, but the reformers saw that what they had to do was to drop the fiercely Republican partisan name of Aldrich from the bill, and with a few minor adjustments, rebaptize it as a Democratic measure. Fortunately for the reformers, this process of transformation was eased greatly in early 1912, when H. Parker Willis was appointed administrative assistant to Carter Glass, the Democrat from Virginia who now headed the House Banking and Currency Committee. In an accident of history, Willis had taught economics to the 2 sons of Carter Glass at Washington and Lee University, and they recommended him to their father when the Democrats assumed control of the House. The minutiae of the splits and maneuvers in the banking reform camp during 1912 and 1913, which have long fascinated historians, are fundamentally trivial to the basic story. They largely revolved around the successful efforts by Laughlin, Willis, and the Democrats to jettison the name Aldrich. Moreover, while the bankers had preferred the Federal Reserve Board to be appointed by the bankers themselves, it was clear to most of the reformers that this was politically unpalatable. They realized that the same result of a government-coordinated cartel could be achieved by having the President and Congress appoint the board, balanced by the bankers electing most of the officials of the regional Federal Reserve banks, and electing an advisory council to the Fed. However, much would depend on whom the president would appoint to the board. The reformers did not have to wait long. Control was promptly handed to Morgan men, led by Benjamin Strong of Bankers Trust as all-powerful head of the Federal Reserve Bank of New York. The reformers had gotten the point by the end of the congressional wrangling over the Glass Bill, and by the time the Federal Reserve Act was passed in December 1913, the bill enjoyed overwhelming support from the banking community. As A. Barton Hepburn of the Chase National Bank persuasively told the American Bankers Association at its annual meeting of August 1913, quote, "The measure recognizes and adopts the principles of a central bank. Indeed, it will make all incorporated banks together joint owners of a central dominating power." End quote. In fact, there was very little substantive difference between the Aldrich and Glass bills. The goal of the bank reformers had been triumphantly achieved. Conclusion. The financial elites of this country, notably the Morgan, Rockefeller, and Kuhn-Leb interests, were responsible for putting through the Federal Reserve System as a governmentally created and sanctioned cartel device to enable the nation's banks to inflate the money supply in a coordinated fashion, without suffering quick retribution from depositors or note holders demanding cash. Recent researchers, however, have also highlighted the vital supporting role of the growing number of technocratic experts and academics who were happy to lend the patina of their allegedly scientific expertise to the elite's drive for a central bank. To achieve a regime of big government and government control, power elites cannot achieve their goal of privilege through statism without the vital legitimizing support of the supposedly disinterested experts and the professoriate. To achieve the Leviathan state, interests seeking special privilege and intellectuals offering scholarship and ideology must work hand in hand.